Good morning, everyone. How are you today? Good to see everybody. I always look forward to this panel of private equity masters up here on stage, and we are about to hear their wonderful insights once again at the Global Conference. Joining us right now from left to right, Scott Sperling, Jonathan Sokoloff, Jonathan Nelson, David Bonderman, and Leon Black at the end, talking about new directions in private equity. So gentlemen, why don't we start with the environment in terms of where we are. How are you feeling in terms of the backdrop for investing versus where we were 1 year ago? Scott?
Well, I think obviously the markets, both the credit markets and the equity markets, have strengthened over the course of that period. The credit market in particular has had a pretty strong run for about 24 months, interrupted only in the middle part of last year. And interestingly, in the middle part of last year, I think you saw more transactions happen in the private equity world because we saw a softening of pricing, seller pricing at that point that allowed some deals to happen. With the strengthening of the credit markets, it's become more difficult in many ways to find transactions priced at the level that most of us would like to buy these companies at. And so we've been using the strong credit markets to help refinance companies. Some of that refinancing will take the form of dividends. Other is just to extend the maturities and lessen the cost of capital for these companies. Those are all good things for those particular portfolio companies. The lack of transaction volume that we've seen to some large extent, though, reflects the broader macroeconomic uncertainties that exist. And even though the markets themselves have been strong, I think we all see the storm clouds that are on the horizon, and really at this point don't know whether they're going to be blown away or will strengthen. And I think that's something that's going to continue to keep the market, in terms of the volume of activity on the M&A side, particularly from a private equity perspective, probably softer than many would have predicted.
Yeah, it's interesting. I would have expected a lot more deal flow, given the level of interest rates and given the level of cash on balance sheets. But let's continue with this broad landscape first, Jonathan.
Well, I think to follow up on what Scott said, there was a little bit of a binge of activity in 2012, somewhat motivated by tax law changes, and so there are a lot of really interesting businesses that came up for sale. If you're going to sell a good business, you probably want to sell it in December rather than January. But fast forward to today, I think the number of private equity deals done in the first quarter was down over 30% over last year. We are seeing a complete disconnect between the performance on Main Street and the performance on Wall Street. We have a fairly diverse portfolio of over 20 consumer-facing businesses, and top-line trends have definitely softened in calendar 2013. Is it that the paychecks are a little bit smaller? Is it weather? Is it global uncertainty? We don't know exactly what it is. It's not alarming, but it's broad-based enough to definitely be a trend throughout our portfolio. So we view that Americans are tightening on their wallets a bit in kind of discretionary consumer spending. In the meantime, every day the markets hit new highs. It's kind of euphoria out there in the equity land. So in our business, that's kind of a time to take a pause, to wait, and to watch. It's a little bit frustrating because most of us come out of the credit market backgrounds, and it's so seductive to want to borrow as much money as you can today. We have dividend recapped, refied, repriced, or sold just about everything we can. We're kind of running out of those opportunities. In the meantime, we're having trouble deploying capital. When the stock market was up 15% last year, it's up double-digit again this year, and we're seeing a little bit of uncertain trends at our companies. So it's a time to be cautious.
Yeah, it's interesting. Many of you are focused on consumer businesses, whether it's consumer businesses in China or throughout the emerging markets or the United States. So that's going to give us a real window into how you folks and others are allocating capital in an environment where you are seeing some belt tightening out there. Jonathan.
Yeah, I know you don't like it when we agree on the panel.
No,
I agree with Jonathan.
I'm indifferent.
So, that you posed the question, or started to, if conditions are so great in the credit markets and there's an abundance of equity commitments in our industry, why are deals flat?
Or down 30%.
Or down. And I think it's probably not one factor, but a number. To start with, there is uncertainty, it must be said, about what the future looks like. We're in the middle of a giant experiment in terms of monetary policy in developed markets. The US, Europe, UK, Japan, those governments and their countries collectively account for 70% of all borrowing, and the central banks in those same countries account for about 60% of lending. That's unprecedented. So we really don't know how this will unfold. In the US, where we allocated most of our capital over the last 3 years, it's about 55% now. We do operate around the world. We like what we see, but we would call it a low growth, relatively low risk environment. It is, the tallest midget among territories. We like it. Europe, well-chronicled issues. Southern Europe is more bound. Northern Europe is better, but low growth. For us, that's about 18% looking over the last couple of years. It used to be as high for us as 41%. So that's way off. Asia is up. It was about 20% over the last 3 years, 23% actually over the last couple. And Latin America is the balance for us. And Asia is not without its issues. Growth has tapered off. There are different risks. They're generally micro risks. And I think they are generally not appreciated by, I would go so far as to say, limited partners. When you're on the front lines of those deals, and many of us are, there's huge risk, and the question is whether or not we're compensated for it. But it is, while this is much better than we were 5 years ago, it does feel for most of us as there's a disconnect between the public equity valuations and what we're experiencing and what we're worried about. And then I'd say finally about the conditions it is about mean versus median when you look at deals. Big deals are generally absent. There are a few anomalous transactions. But the number of deals is actually in pretty good shape. It's just the average has come down. And there is a huge supply that's building up right now of deals, some 6,500 companies that we and our brethren still maintain in our portfolios, which is double the number coming into the financial crisis. Those will come out, and many of them will be buyouts again.
Yeah, it's an interesting point that you make, big deals absent. And we're going to drill down on that coming up. And also Asia, obviously, very important market. David, you are in Asia all the time, and that has been a source for your investing. How do you see the broad environment?
Well, one of the advantages of being in a 5-person panel is that by the time you're fourth or fifth, Leon and I actually don't have to say anything since it's all been said already, which probably fits with our intellectual makeup anyway.
Well, next time I'll begin with you then.
If there is a next time.
No, I mean the next question.
Oh.
No, I mean the next question, so that you engage and give the audience some information.
Well, the question you started off by answering, which provoked some very thoughtful responses from my co-panelists, was what's changed since last year? And there are a few things that have changed. I will start by saying that most of what my colleague said, I think, is true. What's changed are a couple of things. First of all, I think we've all come to terms with the notion that Europe is not going to fall into the sea. Nobody is panicked about Greece anymore. Nobody thinks the euro is going to collapse. Everybody understands that the Germans will do what Germans always do. That can be a problem, of course. But Europe is going to continue to exist. It's just going to have less investment opportunities than people thought when they raised Europe distressed debt funds. And it's going to be a long time recovering. So that's one thing that's changed a bit. People are feeling better about Europe despite what's going on. The second thing that's changed a little bit is that There is some movement back into the emerging markets. Before that, there had been a flight to safety. The U.S. Announces a larger deficit and differential treasury views, and money flows into the United States because in the past few years, because people were thinking they were fleeing to safety, and when the U.S. with its economic problems is safety, you know that you're in for trouble. But that's second thing that's happened. We're seeing differential things. Places like Indonesia, where we have been historically investors, have become very pricey as people moved in. Places like China have become, in my view, oversold for all the woes of China. People loved China when the PEs in China were 5 times the PE in Indonesia, and when it's half as much, they don't like it anymore. So it's the usual kind of status. And so the major changes are Europe is better, at least perceived to be. The U.S. is still safety, although the numbers are a bit worrisome, as my colleagues pointed out. And the emerging markets are starting to reemerge in bits and pieces.
You know, I want to get into at some point your thoughts on Japan with all the stimulus going on there. I mean, I know stimulus is the watchword of the day all over the world. But in terms of Japan, where I know that you are also dealing and doing business, what's your take on what's going on there with the new strategy of stimulus?
Well, you know, of all the places we operate, and we're quite global, Japan is the only place in the world where there is less competition today in our business than there was 10 years ago. Lots of people have packed up and gone home. Japan is problematic. They are going to continue to, the Bank of Japan is going to continue to provide lots of liquidity, but the place has, and I've said this before, I think I've said this every year, I think Japan is one of the most challenged places on the globe, despite the fact that it's the world's 3rd largest economy. There is no culture of personal responsibility. There's no culture of corporate responsibility. Guys get indicted and they run the company from jail. The demographics are terrible. Pretty soon the entire country of Japan everybody will be older than me, and that's pretty challenging. Right? And they're xenophobic, so they don't encourage people to come to Japan and work. So over time, I hate the place.
Leon, I guess, you know, since we spoke last, there's been more certainty, obviously, with the election. Talk to us about the landscape from your standpoint, your credit angle, and whether or not you're finding the distress stories and value out there.
Sure. Well, first of all, it's great to be back at the Milken Global Conference, and Mike has done it again. Amazing.
It looks like it's getting bigger and more fruitful every year.
And it's also wonderful to be up here again with you, Maria. You always do a wonderful job in making this an informative and an entertaining, thank you, David, session.
Yes.
So, and what I've always liked about this panel is that there's always a variety of talent here. You know, in our business, there are many roads to Rome. I think what you have up here are 5 very different operating models and different views of the world. So it's great to be up here with my colleagues and go at it on a variety of subjects. Look, from Apollo's point of view, if I were to characterize this environment, we think it's a fabulous environment to be selling into. And over the last 15 months, we've been a net seller. We're selling everything that's not nailed down in our portfolio, and if it is nailed down, we're refinancing it at great rates. You know, that doesn't mean that there isn't a selective deal to do here and there in different businesses or industries that we focus on, but net, it's a better time. You know, it's almost biblical. There's a time to reap, there's a time to sow, and right now we are harvesting. And there's a great refinancing market for dividend recaps. There's a great IPO market, and there are even opportunities now for strategic sales. So that is what we have been most focused on the last 15 months. And you know, if the credit markets and the equity markets continue to cooperate, which I believe they will over the next year, because I think interest rates will probably stay low with the Fed's policy for the next 12 to 18 months, we will continue to harvest more than invest. So, you know, for us, you know, we've had $13 billion of realizations over the last 15 months, which is more than we've ever done in any period like this, and I think that will continue. Now, that's not to say, I mean, our operating model is one that we are a value investor. We like to buy good companies at low prices, and we like to do it in differing environments. You know, our view right now is the market is pricey for doing conventional buyouts. The average transaction in the U.S. of over $500 million is being done at a 9 multiple of EBITDA. Inexplicably, in Europe, it's even higher. It's 9.5 to 10. You know, I think our view is that when you pay that type of multiple, you're pricing to perfection. You have to believe that interest rates are going to stay low for the next 5 years. You have to believe you can get out at the same multiple you got in at, and you have to believe you can grow that company a lot more robustly than the underlying economy. Ironically, probably that last piece is the one that's the most doable in various businesses and with various managements and products that all of us, you know, have an expertise in. But to bet on all three of those things happening and to be able to generate, you know, a private equity rates of returns in the 20s is a very tall order. And that's one of the reasons why we're more a net seller today than not. You know, that doesn't mean that there aren't opportunities. And when you do find opportunities, it's great to have low-cost financing right now. The financing market is as good as we've ever seen it. You know, it's back to 2007 levels. You know, there is no institutional memory. You have the covenant light, you have low rates, high yield rates from an absolute point of view have never been this low. They're 5% or lower for you know, high yield bonds. I've never seen that. I worked, I remember, with Mike in '77 on the first public high yield deal for Texas International, an oil company, of $15 million. And you know, we've never seen rates like this. So of course, if there is a deal in an industry you know well, or any of us know well, it can be attractive from the financing point of view, but again, you have to be able to get it at the right multiple, or you have to believe you have secret sauce to really be able to transform it or grow it to build the type of value that's needed to get the types of returns. You know, this is not what I would call a robust distressed market a la '08, '09. But, you know, distressed is something that you don't have to have a global economic collapse to find good distressed deals. Yes, that's when you'll do the most in that type of environment. But, you know, a lot of industries are inherently cyclical. And you know, clearly when a lot of people are paying 10 times for companies, that may be the next group of companies eventually that will be good
Right.
for distressed. There are certainly some companies even in these robust markets, that have not been able to refinance and are facing maturity walls. We did a deal recently with Oaktree in Australia called Nine. That was done 6 months ago, which clearly already the economy's recovered. So yes, there are distressed opportunities, but it is not, I'd say, the economic collapse type of opportunity that it was 4 years ago.
Well, it's interesting that as part of that $13 billion realization you just mentioned, you IPO'd that Puerto Rican financing company, and being a seller in this market. Does everybody on the panel agree that things have gotten pricey? I mean, David's talking about, Leon's talking about, being a seller these last year because prices are getting away from people. Do you agree with that?
I don't know that prices are getting away, but it's a good time to be a seller. What's unusual about this market is it's a very good time to be a seller for all the reasons Leon set forth, but it's not a terrible time to be a buyer either. You have to be cautious on the pricing, but because of the nature of the financing that's available, which is, as Leon said, is virtually unprecedented, it is not a terrible time to be a buyer. So you're seeing some activities, but because the corporates of the world are flush with cash, you're not seeing corporate divestitures, spin-offs, all the kinds of things that are bread and butter for this industry at some times in the market. This isn't that time.
Yeah, let's talk about that cash. That would be slide number 2. And then go to slide number 3. Companies hoarding cash, sitting on this cash. Why so much hoarding of the cash, given the fact that things do feel a little better? I know we're not back to vibrancy in terms of the economy, but we're seeing signs in housing, we're seeing signs in some consumer businesses, and yet companies sitting on cash.
Well, again, I think it's the same concerns that we have about the overall economy and the direction it's taking. I believe most corporations are looking at the same sort of thing, remembering what the world was like back in 2007, 2008 when things came apart. Now their balance sheets are much better. I think you're starting to see some level of activity. If rates are low for us in the high yield world for corporate rated debt, it's incredibly low. 1.5% to 3.25% would be not atypical for the cost of debt for these corporations. And so what they're starting to see is that almost everything is becoming accretive when they look at that. And that might start to open up some of that cash coming out. But to the broader issue of whether or not things are expensive, again, all of the good things about very low price debt are true, as my colleagues have talked about. And it's also true that that low price debt then goes into the equation that most companies and sellers use to calculate what they think their asset is worth. And so they run all the same models, and they have bankers who are advising them who are saying, for private equity to get a 20% rate of return, if you can leverage this thing 7 to 7.5 times with an average cost of debt of 5% or 4%, given the mix, they ought to be able to pay X. And that's the high multiples that Leon was talking about. The reality is we saw that story before. We saw that back in 2007, and I think most of us are saying that there's intrinsic value to companies. You can't count on the sustainability of these credit markets, and it doesn't make any sense to pay that price, even if it pencils out in the right way. And if you do that, if you go through the calculus from the buyer's perspective, you have this gap that hasn't closed between the buyers and the sellers right now, which means you have to do a bunch of what I think both Leon and David were talking about, and I think all of us are doing that, which is you have to spend a lot more time trying to create transactions, whether it's a platform company or it's a relationship with a strategic where you can target a specific acquisition to joint venture on, or it's working the network that you have to create an opportunity. And that's a longer lead time set of activities. It's obviously much more, requires much more intensive work. And so the fruit of that, I think, is what you're starting to see now coming out in some of the deals that have been talked about and announced, and I think that will grow over the next year. But it's not going to make up for the volume spread between expectations and given today's environment where deals otherwise would be done.
Let's show slide 7, because obviously this low rate environment is a big part of this enormous story. But there's this debate about when, in fact, we may, you can see it right here, gentlemen, in front of you, Leon, look right in front of you. There's this debate on when, in fact, we might see the Fed start winding it down. And I know that, the economy is still sort of shaky, I guess, in the U.S., but what's your take on when we might actually see real movement in terms of bond yields moving the other way?
Look, I think most people are operating on the assumption that it's going to be a while, that we're going to be in an environment of low rates, and when it does turn, it could turn fast, and it could be very chaotic and lots of opportunities. But to focus even on your last point, corporate America is just so unbelievably cash generative. It's kind of an ATM machine, just spitting out the cash, and they don't know what to do with it. A lot of people were freaked out by the financial crisis, and that some companies just say, I want to have $1 billion of cash on the books no matter what, because I want to be self-insured. Other companies have very, very mixed records. And acquisitions, a lot of acquisitions are busts. They're mistakes. They're full of problems and aggravations. So what else is going on is there's massive share buybacks going on. It's kind of like the creeping privatization or going private of the American equity markets. And equity capitalizations are dramatically shrinking. It's almost a little subset of what we do here. But again, how do we generate returns for our investors? In this environment, we have a little bit of a different take than, for example, Apollo. We're a little bit more of a growth investor, and we're willing to pay up and are paying up 9 or 10 times cash flow for a business that we think is a real growth business. And even in an economy with very low single-digit GDP growth, high single-digit unemployment, if you can grow nicely, you can make money paying those kinds of prices. That's not traditionally how our industry has bought things, but we have done very well doing that. If you look at the public equity markets, they are putting an absolute premium on growth and valuing some growthy businesses at 12, 15, 20, 25 times EBITDA. Now, we never count on multiple expansion like that, but if you buy a great growth company at 9 or 10 times and you think you can kind of get that going out and you might benefit from multiple expansion, that can be a wonderful way to create opportunities. The other thing that we're seeing is there are a lot of entrepreneurs, owners of businesses that don't want to be public. And our business is generally a control investor. We've had some tremendous success recently in crafting long-term relationships with some entrepreneurs and buying significant minority stakes in great businesses that are growing, where the founder doesn't want to sell. He may want to take some chips off the table. He may want to de-lever if he's levered. And that's, we're private equity. We're very flexible. We can do all kinds of different structures. It's one of the beauty of our model for all of us, as opposed to being a mutual fund or something like that. So you have to be flexible, you have to be nimble, and you might buy 40% of a business instead of 70% of a business. And if you have the right governance and protections, it can be very successful. And while you'd always love to buy control, if control is not available, but a very significant minority stake with rights is available, we have found that even in this environment, there are opportunities to make those types of investments.
And those opportunities, I mean, you have focused and had priorities in housing and auto and really consumer businesses. Are you saying you're willing to pay up in those businesses?
Well, we actually don't focus a lot on housing and autos, because those are the parts of the consumer economy that are very volatile and got killed in the downturn and are actually doing quite well today. We're a little more in consumer staples, a little more steady businesses. But it's not so much the industry, it's the entrepreneur, it's the founder, owner, CEO, management that might want to do something. And we have to plant a lot of seeds and schlep around the world like we all do to meet folks, and occasionally you find a situation that we craft a structure that is really customized for that company. And that's one of the things that private equity can do that many of other asset classes can't.
So where are you willing to pay up then?
Fundamentally, we pay up for growth. If we think a business's cash flow can be at least 50% higher, maybe 100% higher in 5 or 7 years, even in a very anemic economy, we will pay up for that asset. If you're wrong and you pay 10 times and they don't grow, you're dead. You can't financially engineer your way out of it. You'll probably have multiple contraction. So you have to really do your homework, and you have to be right. And our job is to be right a lot more than we're wrong.
And you've done consumer businesses in terms of sports, media. Talk to us about the opportunities there, Jonathan.
Well, like the other Jonathan, we tend to focus, and that leads us in media, in our case, and education and communications. And what we're looking for are businesses that are, first of all, they're generally not correlated that well with the economy as compared to many businesses, because they're either part, I mean, NFL that you mentioned.
Like the sports, right.
Sports is a great example. NFL, if you tracked their revenues, if you looked at it as a business, you'd see no evidence of a financial crisis, of a slowdown in the US economy. By the way, you would find that they're just the biggest, but generally sports, because we're in soccer, we're in baseball, those rights fees, which is a measure of their value, have been growing at incredible rates in a period where you can't say we're growing either in population or income, but they're of increasing value. Why? Because they occupy a sweet spot in premium content that they can't be pirated. They're worth much more live. They're not replaceable, and people love it in good times and bad. I mean, many people who watch consider it essential. And I would say all of that is compounded by the proliferation of platforms, devices, mobile, internet, and all of that will, we think, increase the value of premium content. And in a world where those content creators that have a unique and franchise, NFL is a great example, and by the way, not fully capitalized on a digital world, will, we think, move in not with GDP, but for as far as we can see up. And that's in the US. This is a global phenomenon. We are just early in the effects of broadband cost and ubiquity and speed around the world. We see in education, which is a giant industry, about to be transformed by digital delivery. I mean, many students saw for the first time this past year textbooks digitally. One would think that it will go the way of of a rotary telephone, a textbook, in time. I'll be a granddad then, and that's actually not that far away, but the notion of a kid lugging around textbooks, not going to happen. And that's going to drive the value of education, the reach globally around the world in ways that have nothing to do with GDP. Everything that we talked about on this panel about credit, about risk, about uncertainty, about capital markets, has nothing to do with the phenomenon that I just described. My guess is that each of us search for ways to differentiate what we do, which is the beauty of private equity. We all have different strategies. Leon said it in different words. We are different. Now, maybe only in this room do we really look that different. I think to most of our consumers of media, we all look the same. Let's face it, shades of gray. But to experts in this industry, I mean expert investors, limited partners, we are very different. And I think that is actually, if you're thinking about where private equity is going, I think it will be increasingly the case that if you're just supplying risk capital, long-term risk capital, that is not enough to succeed. You need to bring an IP, a differentiated knowledge base or set of relationship, but it's knowledge, it's not capital, that will determine the success of firms, hopefully like all the firms here, but I'd say generally across private equity.
Look at slide number 12, which really is the breakdown of private equity money today in terms of regions. And you see that the majority is in North America. But David, you mentioned earlier that things are looking a little better or feeling a little better. We're not as panicked about Europe. And yet we just had that whole situation in Cyprus where the depositors had to really take a haircut because of that. Do you worry that that becomes a standard in terms of bailouts? The Cyprus situation, walk us through the Europe story right now and why, as you see here, Europe's 29% of private equity dollars.
Well, just a comment on Cyprus. It's pretty clear to everybody that what the EU did in Cyprus was the height of stupidity. It just makes no sense, even if you don't like the Russian depositors, it doesn't make any sense to haircut depositors because it has major impacts for how people will treat the banks in other European countries.
It's scary.
And I think the EU actually already recognizes that they made a mistake there. That was not a good idea. But what's going on in Europe, as was alluded to by some of the folks here, are different things in different places. There are economies that are marginally robust, like the Netherlands and Germany, even if they're not trending very much in the right direction. You've got the Southern European economies, which have these horrible unemployment numbers, although they're artificially inflated, because all these countries have gray economies since people don't want to pay taxes. Surprised about that, huh? So you have economies which are not as bad as people think they are from reading the headlines. But Europe is in a long-term transition. They're living off of 1,000 years worth of investment, and they're disinvesting. And Europe is a little different because the Europeans don't care about growth, no matter what they say. They're the opposite of John Sokoloff here, who only cares about growth. Mm-hmm. The Europeans only care about social stability. They care about the social compact. They want to make sure that people aren't digging up the cobblestones in the Place de la Concorde and flinging them onto the highways. That's what they care about. In the U.S., in Great Britain, in the emerging economies, people are trying to expand the pie. The Europeans aren't trying to expand the pie. They're trying to argue over who gets what slice. And so it's a different place. But there are opportunities there. They're not many. It's a slow growth environment. And so unlike some other economies, you have to be very cautious on your spots. But Europe isn't going to fall apart. They do have a lot of embedded assets. They have a well-educated workforce. And life is cyclical. Things will improve.
So are you putting money to work in Europe?
Some, not tons, but some. We've done a few deals there. We bought into a bank in Denmark called Saxo Bank, which is one of the world's leading currency traders, which profits on volatility as opposed to on growth. We did a huge restructuring of a failed real estate conglomerate, which has 82 office buildings in the Netherlands. So there's been things that we bought a $3 or $4 billion face portfolio from one of the British banks. So there are things to do. It's just, it's got to be idiosyncratic, a little one-off, and there's no rush.
Leon, what about you in terms of Europe? What can you tell us? I mean, you said there are some distress, but it's not, as significant as obviously it's not 2008. But what are you seeing in Europe from your standpoint?
Look, I would agree with what David just said. Our history has been one where we've invested in the U.S. about 80% of our capital, Europe maybe 15%, and the rest of the world, I'd say, is the last 5%. In various industries that we know well, whether it's chemicals or cable, we've played. We bought an insurance company in England. We had a number of cable companies in Germany. We have a metals company we bought as a division of Rio Tinto years ago, where Rio Tinto stayed in and the French government stayed in. They do canning and aluminum for aerospace sidings. So there have been deals to do selectively. And we still think, again, in certain industries, here and there are things to do. But one, the pricing seems very high in general right now, and the underlying growth in Europe is negative to flat. So that, I don't think, makes for a great corporate deal environment. Having said that, an area that has been more interesting has been for us non-performing loans, distressed. The situation in Europe, I mean, when we looked at what happened here in the U.S. with the banking crisis five years ago, I mean, I may not have my numbers exact, but our GDP was roughly 15 trillion. Our banking loans added up to about 12 trillion. In Europe, the GDP is about the same, but the banking loan amount is like 60 trillion, or 5 times as much as it was here. And they didn't have a central authority like the Fed to help them navigate through that. So there's no question the banks have to delever, but that's awfully hard to do, to take the marks that are necessary to sell down. But on a trickle-down basis, they are selling, and there are things to do, whether it's in Spain or Portugal or Ireland or even in Germany. A lot of it is more consumer credit related. A lot of it's real estate, related. It's less on the corporate side, but there is an interesting business there in terms of the distressed side, although it's not like the floodgates have opened just because of the politics realities.
I'd like to just add a point to what Leon just made. Because of the statistics, as he suggested, the European banks were vastly more levered than the U.S. banks. And the European governments understood that.
European banks are what, Les?
Vastly more levered than the U.S. banks. I mean,
So they have to shrink their balance sheets.
Right.
That's the need.
And the European governments understand that. They also understand that they are the source of capital as a last resort. So if they make the banks the assets right now down to their real levels, the banks will be capital short and the governments will have to fund it. The governments don't want to do that, so they're not making the banks write anything down, so they don't show a loss. In the banking business, you're solvent as long as the Fed or its equivalent says you're solvent and lets you borrow at the window. So that's what's happening in Europe. Prices are artificially high in the banks because they're not willing to take write-downs because they can't afford to. That means they're going to have to earn their way out of it over a long period of time. And that's what's happening, and that's why there's not the same kind of asset flow out of the banks that we saw 5 years ago here. And that's why it's not going to happen in the same way in Europe.
But at some point, does something got to give? I mean, at some point, are you going to see lots of asset sales? Are you going to see more capital raises going on for those European banks?
In a trickle-down sort of way.
They need to shrink by 2 to 3 trillion at least, but because of the political realities, it will not be a flood event. It will be done on a trickle-down basis. So you just have to be there, when it's trickling in an area that you find attractive.
Mm-hmm. Just to give you a sense, Marie, we're largely a U.S.-focused firm, but we did make a sizable investment in a U.K. company recently, and we kind of did it for 3 reasons. It's in the fast fashion retailing space, and it's kind of a dominant company in the U.K. You look at that industry, the owner of Zara is the 3rd wealthiest man in the world. But the UK is kind of lousy right now, and we wouldn't do that in and of itself, but we in our space in private equity can look out 5 to 7 years. So our feeling is over the life cycle of our investment that the economy will probably turn. Also, it was a very, very highly structured deal with an entrepreneur owner. We also felt we perhaps got a lower value or a lower multiple to accomplish some of his other goals than some of the higher multiples out there. And lastly is growth. It has 3 or 4 stores in the United States, a limited presence internationally. And we think it has dramatic potential to grow here as well as globally, which could turn into a real global growth juggernaut and get a much higher multiple. And if we're wrong on that, it's still probably an okay deal. The UK will be okay. They're not going away. And it's very, very cash generative. We think our downside is covered as well. But that was kind of a 2 to 3 year courtship structuring oddball deal that people in our industry do.
Yeah, we've spent a lot of time, and we, I think, mirror the conversations that investors have with us, all of us, on macro issues, which always lead to GDP growth. When return on equity is not correlated in a 5-year period with GDP growth. China is going to prove this point. So they've been growing at 8%. And if this were true, that 8% and the US 1 to 2%, 8% leads to higher return on equity, and you want to allocate more dollars there, I don't think it will work out that way. because GDP growth says nothing about valuations, says nothing about risk. And I think that it is not accidental that most of us have, by I would say, standards of the last decade, allocated much more capital to the U.S. than other regions. It's not because the U.S. is growing. Because if it were just about macro conditions, growth, we'd be, backing up the truck in Asia, and we're not. Actually, just the opposite. We're more cautious there than we are here, and we're deliberate in the U.S. But there is almost a seduction to go where the economies are growing the fastest. And obviously, you want to avoid shrinking economies, which is roughly half of Europe. But it's not true that you want to chase GDP growth. And I think we'll see that. This industry is allocated, and still is, what I think it will turn out to be an unwise allocation in emerging markets. It takes a while before we see those returns, but many of the most exciting countries in terms of GDP growth are fraught with risk, and we'll see what exits actually look like. We've been very cautious in China, where we do have an office.
Why?
Because of the tension between the macro picture, that it's growing, and huge emerging middle class, which is generally very good for the businesses we're investing in, media in particular, education. But because of a set of micro issues which you don't show up in any national numbers. And it has to do with exit, has to do with governance, has to do with law, has to do with tax policy. There are a range of issues that get in between an investment and our exit. Mm-hmm. Because we're not economists, we're investors at a micro level. And I think many of us, well, those that are on this panel that are engaged in that part of the world, could tell you stories that would terrify you. Now, you've got to be very careful, but my point is, it's a great example of GDP growth does not equate to return on equity. We have to resist that notion in allocating capital.
Yeah, I think that's a great point.
I think Jonathan's right, but I think there's one other point, which is we predominantly invest in companies domiciled in North America, but most of them are global companies, as most of all of us invest in. And so we can play global growth, but do it through the strategic relationships that we have through our portfolio companies. And I know we all spend a lot of time, and I know we spend a lot of time trying to help our portfolio companies manage that, particularly in Asia, where having the right set of relationships and joint ventures is often very important to them. But you can invest in a North American domiciled company with all of the protections that Jonathan was just talking about, with the risk mitigants that come from investing in a place that you know better and have those protections, and yet still be able to play global growth because your companies are working as strategics in those areas. And so we found that you can get the best mix, if you will, from doing that. International for us is very much a rifle shot that occurs only every few years.
I'd like to look at slide 13 and then 22. And it's because something that you mentioned, Leon, when you were just talking about chemicals and the mining companies, this is long-term stories, it appears to me, these mining companies, and yet over the most recent short term, they have just plummeted and have really seen some distress. How would you characterize investing in, chemicals, mining, metals, all these companies that have come down in price so much, certainly in the public markets, and I assume in private as well?
Well, I don't think I'm not an expert on mining companies in particular vis-a-vis the commodity play or commodity trades, or where these products sell on a daily basis. Or
do you see value there?
But I do believe very strongly that one of the areas that has the most upside over the long term is in natural resources. And that's metals and mining, and that's energy, and that's agricultural products. It's an area that we have built up our team quite dramatically in over the last 5 years. And I just think supply-demand dynamics in terms of the world, and over the long term make a lot of sense. I think there are deals to be done today where, given the shale revolution that's happening in the U.S., there are, big energy companies that want to participate in developing that, and they think it will have more turbocharged returns. And to raise cash, they're selling off proven reserves in the U.S. And if you look at the pricing of the physical assets, and you look at where they're selling, and you're able to kind of hedge production to protect your downside, I think there are opportunities today to generate very nice private equity type returns. So I'm not, Apollo, I don't think, bets on the daily commodity prices, which can fluctuate very dramatically. I think it's more a long-term play, and being with the right company and getting in at the right price.
Yeah, and energy is a space we've talked about.
Right.
Did you want to say something, John?
Yeah, I'm looking. You did a better job than we did in studying the slides for this panel. I don't think any of us looked at them, actually.
Well, I know.
Until you put them
Leon
up.
was looking at them.
But because my guess is you hadn't seen it before. But we all, and I shouldn't question any slide that shows buyout and distress near the top, at the top. That's a wonderful thing. But the only line I actually understand is the one that says S&P 500. I don't know how you can actually calculate the return in 2000 of a buyout fund.
Okay.
Because it's either a fund which made commitments over probably roughly a 5-year period. So that doesn't sound like 2000, unlike the S&P. Is it investments made in 2000? Maybe.
We'll ask the Milken folks.
Is it
They put this,
yeah.
they put this chart together.
But it
How
is a
they-
wonder, we don't want to go too far with that. It's a great result. That buyouts did so well and venture didn't, because I think there are none of us in venture. So it got to the right result. I'm just curious how they did
Yeah,
it.
we're
But
going to find out from the Milken folks how the heck they got to this buyout chart. I think the chart of 22, number 22,
Oh, good.
tells
Let's
the
go to that.
story of this panel, by the way. Look at this. Number of exits. And that's exactly what Leon was talking about when we started off on this panel. Sellers.
Well, look, the private equity is not immune to market forces. You buy in the market, you sell in the market. When nobody's buying, we can't sell. When nobody's selling, we can't buy. So you have to expect these kinds of cyclical variations here. But I'd like to make a comment on something that Jonathan said about emerging markets, which I thought was half right.
which Jonathan?
Is there more than one?
Yeah,
That's why it was half
Nelson
right.
and Jonathan Sokoloff.
And which half?
I know that makes you now only a
Which
quarter
Jonathan
right.
was half right.
So,
You said he was half right. Which one?
So he was talking about emerging economies, if you look at emerging economies, and you look at, as he did, say China against the U.S., depends on what your investment thesis is. If I'm in the media business, as Jonathan is, I'm very wary of investing in China, for example, which has all kinds of government and politics and controls about it. And I'd much rather be in a media business in the United States, even if it's lower growth than what I could expect in China. And if I'm in the shoe business, however, I have a very different view, because there's not very much politics around the shoe business, even in China, and it's a high growth business as opposed to the United States, where everybody's got all the shoes that they need and then some, including my wife.
Makes a lot of sense. Yeah.
You know, Maria, I just wanted to say one thing. You talked about your slide about we're all sellers. There's tremendous cash being generated. I think one of the unintended consequences is really a message for some of the limited partners and investors in this room. You know, for the past few years, there was kind of a crisis in our industry because most LPs were over-allocated. Their model says they should have 10% of their assets in private equity, and they had 12, and they couldn't commit to new funds, and blah, blah, blah. And now we've sent tremendous amounts of cash back to them. We're probably not investing and drawing as much cash as we've been sending back, and their denominators are going up. So there are all of a sudden some of our limited partners, I can't believe I'm even saying it, are underallocated to private equity. And a couple, 3 years ago, they were panicked that they had no money. And so we've been in a couple of meetings recently where some of our contacts have said, well, some of our trustees have said to us, well, you have to invest faster in private equity because we're underinvested. Oh, my God, and it's our best returning asset class. And it's great for us because it'll be more money coming into our sector, but it's a danger and a warning because you can't just turn up the spigot and invest faster in private equity if the opportunities are not there. We are a very lumpy, episodic business on both the deployment and the extraction of capital. There's nothing linear about our business as we've described. So that's just something for the investors in the room to keep in mind, as if the current trends continue, that situation will probably be more pervasive rather than less.
That's a great point. And obviously the returns over the 20, 30 year period in private equity the expectations are high in terms of keeping there. Let me get your take on what the story is, small versus large. And if we could put up slide 17 and then 18, we will see that really the trend has been towards smaller rather than larger funds. Why?
That's a really good question, and I haven't been able to figure it out because I've never believed it should be a matter of small or large. I think it really should be a matter of performance. And, you know, there are certain mantras, especially in the endowment community of universities and hospitals, and they believe this, and the actual evidence, when you go through it, does not say that small has better performance than large. But again, I think when an LP goes out, they really need to look at one, the operating model of the GP, what the performance has been in all types of operating and economic environments. And they should go with, you know, who has the best performance. And I'd say in many cases, it militates towards larger. You know, in our case, we are, quote, a large fund, but we tend to have a barbell approach. We do maybe a couple of large deals per vintage. And most of our other transactions are, I'd call, small and medium size. I think it's great to have the optionality to do a large deal if it's really in an area that one is an expert, whether from an industry point of view or in a cycle point of view in terms of distress. It's great to have that option, and the results can be great for the investors. But I don't think, again, it should be large or small, but a lot of LPs and advisors go through periods where you know, something is de rigueur or there's a flavor of the month type of approach.
I understand that slide.
I want to save my best question for last. I know, David, you laugh at me every year when I ask you this question, but the question is, if you could give the audience something, your best idea. I know you don't want to share your ideas with your competitors around the table, but give me your best idea right now. It could be a geography, it could be a sector, it could be, and you're first, David Bonderman, because I know you don't want to be last.
I hate to say this, but Mr. Nelson was kibitzing while you were asking your question.
Okay.
I have no idea what you said.
Okay. Give us one idea. Give us one idea to make us some money here. Anything. A geography, a sector, a name, something. A short, a long, whatever it is, an area that you think is ripe for deals. What is it? One idea.
No, thank you.
Come on. Think about it. Leon, give us an idea. We'll come back to David because he's not ready.
We do this every year.
I know, because you don't want to show your cards.
You haven't gotten an answer out of us yet.
Yes, yes, I have.
I think one year I said if I had a good idea, you think I would tell it
I know it.
to this audience. And I've also said, you know, buy low and sell high, and you didn't like that. But that's...
You're not really going to do that to the audience, are you? Don't clap. That's not funny.
You know, if you give them too much, then they may not come back next year. I think you want to still keep their tongues hanging out. So,
You really going to do this, Jimmy?
yeah.
Anybody have any ideas? Go ahead, Scott.
U.S. energy, I agree with
Nice.
Leon.
Good
and
one.
I like it, and we don't invest in it. So go ahead and.
Wait a second. Why are you telling us
Do
to
we
invest
like
in
the
something
US
that you
energy,
don't
but we
invest
don't
in?
It's not one of our
So go ahead.
sectors of expertise, so we don't invest in it. But I think it's actually a great area.
Energy's a good one. I think you agree with that, David, energy.
Energy is good from time to time, particularly if,
They are the worst.
particularly if you're investing in things that are volume-driven as opposed to price-driven.
The two Jonathans are not going to let me down.
Well, look, it's a tough question, and we've all been very general in our answers and don't want to give our secret sauces away. But I think, Leon's point about fund size is interesting. We raised a fund very successfully about a year ago. We were oversubscribed, but a lot of people turned us down, and I think 80% of the reason they turned us down, 80% of the time, was fund size. Your fund is too big. It had nothing to do with the companies we invest in, the returns, whatever. And so, that was just there was no answer to that excuse because that's what they felt. And in my view, private equity is a very vibrant sector, but within it, it's all about manager selection. There's some really lousy private equity firms, and there's some great private equity firms, and you got to pick the right firm. And so we're not going to tell you what we're doing because we want to keep it to ourselves, but there's some great firms, and I think the great ones will continue to do great.
What is your idea?
Maria, I'll give you a couple.
Give me an
ideas.
idea.
That's called a filibuster.
It absolutely is the filibuster.
We're taught by Mike Milken.
I think in this low interest rate environment that we're all living in, I think alternative assets are a very good place to be.
Oh, you mean like private equity?
I think
That's
like
what I
private
said.
Like
equity
distress?
and illiquid credits.
Jonathan, any ideas from you?
I was sitting here listening to all these ideas, thinking that that by the time you actually got to me, we would be truly out of time.
We're not.
We're not. I haven't seen that slide come up that says we're not out of time. I've seen a few that said we were, but I don't want to promote any one idea except a concept which is very simple: to invest in businesses that are or sectors that are so compelling. You don't have to worry about being right about an economy, a government, a regulation. That the business is so compelling, and many of those ideas are right in front of you. We're not, I can say this because we don't invest in carriers in the US anymore. But think about that business. There are 6 million mobile subscribers in a world of 7 billion. And there are revolutions going on in industry right now that are unprecedented in terms of scale. And that seems to me to be a good place to invest. And there's a lot of room for many of us there, but that's what intrigues me.
I tried, audience. Thank you for joining us. Gentlemen, thank you very much.
Thanks again.
Well, thank you, Maria.
Thank you.
Always.